macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
It's time to stop worrying about the correction and just ride the trend. That's my theme for today. And we're going to look at the trend as it exists, avoid the macro, just look at the charts and try and figure out what trend it is we're riding. First, I'm going to show you a weekly chart here of the SPX, 2 years, and I've got 10 and 20 week moving averages on here, which are roughly equivalent to your 50 and 100 day moving averages. Look how beautiful you could stay in this trend just paying attention to those. And I want to talk about the 10 and the 20 week for a moment because when I was a young trader, I spent a lot of time looking at CQG, which is a quote charting system, and trying to find the ideal moving averages so that I could get in and out of currency trends, whether on a 1 hour basis or a 6 month basis. So I experimented with all kinds of different combinations of moving averages. I used the Fibonacci ones, 5, 21, 34, 9, 18, whatever. And what I found is that they all pretty much work the same. So I decided to keep it simple and just go with multiples of 10s, so 10, 20, 40, something like that. And these work ideally. Let's go back and take a look at this chart. Did they get you, give you a heads up into the corrections that we had in 2012? We'll take a look. We had 2 corrections in 2012, roughly 10% each. One was, maybe this one was in the spring was 11%, and this one was only 9%. But you'll notice that by the time these crossed, when your 10-week moving average rolled over, you were already well into this sell-off into June. So it was almost too late. So people are trying to pick a top there. They really had to pick it when the 10 started to roll over. Again, that's your 50-day or your 10-week. Let's look at the correction in September, October into November. Same deal. Once the 10-week or 50-day flatlined, that was a clue. Hey, maybe you want to lighten up or get short, but you certainly don't want to be selling into that because by the time they crossed, the market had already rebounded strongly. So here we have this nice uptrend. You just step back and take a look at this and you realize, hey, I don't know even if I can't predict what's going on in the macro, I can see that we've got a really strong trend here. And this consolidation in March and April was perfect. Just what the market needed. Sat on the 50-day or 10-week there for a while, and here we go. We continue to trend up. So this is what I'm saying is that you want to stay with this trend, and as we try to predict when the correction is coming, we just end up getting chopped up. At least I have a little bit. So. Simple trend indicators here, it helps you ride the wave. Now let's zoom in a little bit on what's possible. And we're still looking at the weekly chart here. I've zoomed into a 6-month picture. So again, we still have the 10 and 20 week moving averages. You've got what could be forming a bull flag channel here. We've tested 1600. Looks like we might need to come down here and test a little bit lower again. But I think that as long as you don't violate the 10-week on a closing basis, that this trend is still intact and you're going to get a bounce up out of here and a breakout. But again, we're in the summer sideways siesta trade, what I've been calling it, because hey, the odds are that there's a path of least resistance sideways to lower in summer, just after the incredible run we've had. Macro uncertainty with the Fed that adds some volatility, and it's just the season after a strong 15% run in the first half. All right, I want to show you. We'll zoom in a little bit more, and we'll look at the possible inverse head and shoulders formation that formed. And this time we're looking at the spiders on a 60-minute basis. This is actually a chart from end of yesterday's action, where you have this inverse head and shoulders forming. And what did we do this morning? Well, this did give us a pop. This morning we were up above 164 or about 1640 on the S&P, and now we're back down in here towards 163. So, for the bulls to have any short-term momentum, they really want to see this, these levels hold, say 1625 in the S&P and about 163 in the spiders to get any momentum back up. So really, it seems like the path of least resistance in the short term is probably going to be lower here into the FOMC. All right, we talk about sentiment as much as we can, just because we want to see, where are money managers positioned, where are retail traders positioned, what are their thoughts looking forward. Barron's did a good piece about how pension funds are still underexposed to this market, and they tend to be a contrarian indicator because they've missed the run. They missed the great bull runs. I don't know how they did in the late 90s, but I'm wondering if this bull market could be compared to the late 90s with these 20% runs per year. All right, so let's look at this is a unique sentiment indicator. This is the National Association of Active Investment Managers, and these guys, this is smarter money, I would say. You've got a lot of hedge funds, smaller money managers, wealth advisors, that sort of thing, in this survey. I think it's a good mix. And you can see that they're the black line. This is like their bullish sentiment exposure. And remember, in February they got up to 104% net long on their bullish sentiment. And look how cautious they've become. Big plunge here into June. And this is really, the things that we've been talking about, that they're just as cautious as everybody else. And if they've got a lot of profits on the table, they want to protect those profits into what could be a seasonally weak period, big Fed taper issue going on, and they want to keep those gains. So now that they've pulled back so much, I think this puts new fuel in the tank for the market to go higher. Maybe not right away, but there's still this competitive nature among fund managers to buy the dips, and that's why 1600 was bought so aggressively when we went down there, and I think it will be again. We probably need a good test of that before we can go higher. So probably, through the Fed in late June, next week as a matter of fact, and then into earnings season, we're probably still going to be in this sideways trading range, 1600 to 1700, but I look for new highs probably after Labor Day. All right, I'm Kevin Cook. Thanks for joining me in the kitchen.